Most traders don't lose because of bad charts. They lose because their own brain is rigging the game against them. Have you ever wondered why you keep making the same mistakes even when you know better? I'll never forget one of my students during the 2021 AMC Mania. He had the perfect setup. Support. Breakout confirmation. Everything lined up. But the moment his trade dipped, panic took over. He removed his stop loss, doubled down, and within hours his account was cut in half. Now, here's the truth. This wasn't about the stock. It was about psychology. And I've seen this play out again and again with hundreds of traders. In this video, I'll show you how price action trading really works when you strip away the noise, not just the strategies, but the psychological traps that sabotage them. You'll learn how to build discipline, protect your downside, and finally stop repeating those costly mistakes. I've spent over 15 years trading, mentoring, and researching behavioral finance. And I'll share stories, studies, and hard-earned lessons you won't find in trading forums or YouTube highlight reels. Stick with me, because once you see how the market exploits your psychology, you'll never look at a candlestick the same way again. But before we dive in, let's set the stage. Take a deep breath, because I want you to experience trading the way I teach it, with clarity, calm, and focus. My name is Ben, and welcome to Zenstock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. One of the books that reshaped my perspective showed me that trading success isn't about secrets or signals, it's about consistency, discipline, and psychology. Let me tell you why that lesson stuck with me. The book is Price Action Trading: Secrets, Trading Strategies, Tools, and Techniques to help you become a consistently profitable trader by Rainer Teo. Now, I know Rainer has a reputation online as a bit of a trading guru, and usually I'm skeptical of that kind of branding. But here's the thing, even in the middle of the hype, I found real wisdom in his writing. Not because he promised shortcuts, but because he hammered on truths I've seen play out in real accounts over and over. No holy grail, no secret indicator, just price, risk, and psychology. And that's exactly why this book caught my attention. It connected with what I've experienced in my own career. Watching traders hunt for the magic signal while ignoring the only thing that truly determines survival, how they manage themselves when the market turns against them. That's the thread I want to pull on today, his lessons, my stories, and the psychological traps that quietly destroy traders who think they're immune. Let me take you back to a moment in my own trading where that truth became painfully clear. Early in my career, I thought discipline meant staring at charts longer than anyone else. I believed if I just worked harder, I could outsmart the market. But then came one brutal week in crude oil. I had 3 trades lined up, all picture perfect according to my system. The first one failed. I shrugged it off. The second one failed too. That's when the doubt crept in. By the third trade, I wasn't following my rules anymore. I was chasing. I doubled my position size, convinced I deserved a win. You can probably guess what happened. That third trade wiped out the gains from the entire previous month. It wasn't the chart that beat me. It was my psychology. Same thing happened years later with Bitcoin. I saw BTC approaching 100,000. That round number was everywhere. The emotional magnet of the moment. I'd already experienced one sweet ride, so I convinced myself I had the formula. Without adjusting my risk, I bet bigger on a breakout that felt inevitable. Then came the reversal. Price dropped from nearly 106k down to almost 79k within months. I'd anchored on that round number and let overconfidence blind me. I refused to cut losses, holding on because I was right and I didn't want to admit otherwise. It wasn't just Bitcoin dropping, it was my mindset collapsing. That crash didn't care about my plan. It forced me to face reality. Strategies fail. Setups break. But if you don't control the emotional narrative, the fear, the attachment, the hope, you'll let the market steer your behavior, not the other way around. So what are the traps here? Anchoring on round numbers. Overconfidence after one win. refusing to cut losses out of pride. These are the stealth saboteurs that ruin traders believing they've finally cracked the code. Let's dig into these psychological traps and, more importantly, how you build frameworks to stay steady, even when the market tests your assumptions. That lesson stuck with me because it revealed something deeper. Trading isn't a test of knowledge, it's a test of behavior. The market doesn't reward the smartest trader. It rewards the one who can stay consistent when emotions are screaming at them to do the opposite. Here's how I think about it. Trading psychology is like sailing. The wind, that's the market, is unpredictable. You can't control when it shifts, how strong it blows, or when it suddenly dies. But you can control your sails, your balance, your course corrections. Most traders sink not because of the storm, but because they panic and let go of the wheel. So here's my high-level takeaway, the one sentence I carry with me into every trade. The market is a mirror. It reflects your psychology back at you, amplified. Once you understand that, everything changes. Because then your job isn't just to analyze charts, it's to analyze yourself. Now let's break this down into a framework, the core lessons that separate traders who last from those who burn out. Lesson 1. Consistency beats intensity. Most traders approach the market like a sprint. They load up their accounts, binge watch strategies on YouTube, and think if they push hard enough, fast enough, they'll crack the code. But trading doesn't reward bursts of energy. It rewards a steady rhythm. Teo wrote that following a consistent set of actions leads to consistent results. I remember underlining that because it summed up exactly what I'd seen in the traders I've coached. The ones who journaled every trade, who stuck to their process even on the boring days, they survived. The ones who chased shortcuts or switched strategies every week, they burned out. Think about it like going to the gym. One insane workout won't transform your body, but showing up 3 times a week, even when you don't feel like it, will. The market is the same. Consistency compounds. So here's the trap. Inconsistency disguised as adaptability. Traders convince themselves they're being flexible when, really, they're just abandoning discipline. Every time you switch systems out of fear or boredom, you reset the clock on your progress. The real edge isn't the strategy. It's the ability to repeat your process when your emotions beg you to do the opposite. Now, if consistency is the first pillar, the second one is just as critical, protecting your downside. Because without that, no amount of discipline will save your account. Always take care of your downside. That line from the book hit me hard, because I'd already lived through the consequences of ignoring it. I remember one trader I worked with during the Bitcoin bull run of 2021. He was convinced he'd cracked the code. Every dip he added more. Every bounce he bragged about how much his account had grown. But what he didn't see was the trap he was building for himself. His risk per trade was ballooning. His stops were either too tight, so he'd get whipped out early, or worse, he'd remove them altogether. When the market finally rolled over, it wasn't the dip he expected, it was a cascade. Within weeks, his account was down 60%. He didn't just lose money, he lost confidence. And that's the cruel part. Once your downside isn't protected, you're not just bleeding capital, you're bleeding emotional resilience. I've been there too. Early on, I believed risk management was boring. I thought if I just picked the right setups, the rest would take care of itself. But the truth is, risk is the only part of trading we truly control. We don't control if price breaks out or fakes out. We don't control when news hits or when volatility spikes. But we do control how much we put on the line and where we'll step aside if we're wrong. Here's the reality. You can have the best edge in the world, but if you risk too much on a single trade, you won't live long enough to see that edge play out. This is the law of large numbers in action. In the short term, outcomes are random. Over time, they align with expectancy. But you can only benefit if you survive the short term. Think about poker. The best player in the world can still lose a single hand. They might even lose 10 in a row, but if they manage their chips wisely, they'll win across hundreds of hands. Trading is no different. You're not playing one trade, you're playing a long series. And your only job is to make sure you're still sitting at the table when probability finally tilts in your favor. That's why professionals obsess over downside. Retail traders dream about 5xing their account. Pros dream about protecting capital so they can stay in the game for decades. And here's the irony. When you focus on risk first, profits often follow naturally. Because you're no longer desperate. You're no longer trading to get back what you lost. You're trading from a place of control. So here's the trap: focusing on upside while ignoring downside. Most retail traders calculate how much they could make if the trade hits. Professionals calculate how much they could lose if it doesn't. That single shift in mindset is what separates gamblers from traders. And once you internalize it, you realize something else. The perfect strategy doesn't exist. Protecting your downside isn't a fallback plan, it's the foundation. And it's the only thing that keeps you in the game long enough to see your edge work. Which sets up our next lesson perfectly. Why chasing the best strategy is another way traders quietly sabotage themselves. One of the hardest truths to accept as a trader is this: there is no best strategy. I remember when I first started out, I spent years searching for the Holy Grail. I'd try moving average crossovers one month, then Fibonacci retracements the next, then candlestick patterns. Each time I thought, this is it. I finally found the one thing that works. But after a string of losses, I'd abandon it and move on. Looking back, I wasn't trading the market, I was trading my own impatience. Recency makes this point clearly in Price Action Trading Secrets. He says, there's no best trading strategy out there because best is subjective. And he's right. What works for a short-term scalper would drive a long-term swing trader crazy. What works in trending markets will fail in choppy ones. The question isn't what's the best strategy. The real question is, what's the best strategy for you, given your goals, your personality, and your lifestyle? I saw this firsthand with a trader I mentored in 2018. He was obsessed with breakout setups. He'd buy every time price pierced resistance, expecting the big move. The problem was, he worked a demanding job. He couldn't monitor trades during the day. By the time he checked his phone, the breakout had already reversed and hit his stop. He thought the strategy was broken. In reality, the strategy just didn't fit him. Once he shifted to end-of-day swing trading, his results changed dramatically, not because the market got easier, but because his system finally matched his life. Here's the trap most traders fall into: outcome confusion. They judge a strategy by a handful of recent trades instead of hundreds. If the last 3 trades were losers, they ditch it. If they catch one big win, they go all in. This constant flip-flopping destroys the very consistency they need to see results. Think about it like fitness. Imagine switching workout programs every 2 weeks. You'd never give your body time to adapt, never build strength. Trading is no different. Jumping from system to system is like resetting the clock every time you get impatient. That's why the market punishes strategy chasing. It's not that these systems don't work, many of them do. It's that traders never stick around long enough to see the probabilities play out. Remember, the law of large numbers only works if you keep taking trades the same way. So here's my takeaway. Stop asking, what's the best strategy? Start asking, what can I trade consistently, with discipline, without second-guessing myself? Because the market doesn't care about the best system on paper. It only cares about what you can execute faithfully, trade after trade. Once you internalize that, you stop wasting time chasing shiny objects and start building something much more powerful, your own repeatable framework. And that naturally leads to the next lesson, because even with the right framework, no strategy works all the time. The markets are constantly shifting, and your psychology has to shift with them. No strategy works all the time. That truth sounds obvious, but most traders don't really believe it until the market humbles them. I'll give you an example. Back in 2017, during the crypto bull run, trend following was like printing money. You could buy almost any breakout in Bitcoin or Ethereum, and within days you'd be sitting on double-digit gains. Traders who used simple moving averages or price breakouts looked like geniuses. They believed they had found the golden formula. But when the market turned sideways in 2018, those same strategies bled capital relentlessly. What once felt like a sure thing suddenly became a slow bleed. Traders who couldn't adapt kept doing the same thing, expecting it to work again, and watched their accounts shrink month after month. They weren't bad traders, they were trapped by belief. The belief that one method should work everywhere, forever. Recency warns about this directly. No trading strategy works all the time because the markets are always changing. And that's exactly it. Markets breathe. They expand, contract, trend, and chop. If your psychology isn't prepared for those seasons, you'll get blindsided. I've seen it happen countless times with students. They master one setup, and it works beautifully for months. Then conditions shift. Volatility dries up, or liquidity floods in, or news events suddenly dominate price action. Instead of adjusting expectations, they panic. They abandon their system altogether or double their risk, trying to force the same results. Either way, they sabotage themselves. Here's the trap: recency bias. When something works, you convince yourself it will always work. When it fails, you convince yourself it will never work again. Both beliefs are illusions. What matters isn't whether your system wins or loses this week. It's whether you can manage yourself through the losing streaks long enough to see the probabilities balance out. Think about casinos. A roulette wheel doesn't need to work every spin, it just needs to keep spinning. The edge only shows itself over hundreds or thousands of plays. Trading is no different. Your job is not to demand wins on every trade. Your job is to stay in the game, risk small enough, and keep executing so your edge can emerge over time. That means your mindset has to shift from perfection to resilience. Instead of asking, "Will this strategy always work?" ask, "Can I stay disciplined when it doesn't?" Because that's the test that separates short-lived traders from long-term survivors. Once you accept that no strategy works all the time, something powerful happens. You stop fighting losses. You stop taking them personally. They become data points, part of the bigger picture. Losses aren't verdicts, they're information. And that understanding sets up the next lesson beautifully. The real secret isn't in avoiding losses, it's in how you manage them. Risk management isn't just a line on a chart. It's the psychology that keeps you alive long enough for your edge to matter. If there's one principle that separates professionals from amateurs, it's this: risk management isn't just math, it's psychology. I've seen traders blow up accounts not because they didn't understand stop losses or position sizing, but because they couldn't control themselves when the heat was on. They knew the rule. They even wrote it down. But when the trade went against them, fear whispered, "Just hold a little longer." Ego shouted, "The market will come back, you can't be wrong." And revenge whispered, "Double down, make it back in one shot." That cocktail has destroyed more accounts than any bad strategy ever could. I'll never forget a friend of mine during the March 2020 crash. He had a plan: cut losses quickly, never risk more than 2% per trade. But as the market tanked, he froze. His positions bled far past his stop. He refused to exit because admitting defeat felt worse than losing money. By the time he finally closed the trades, half his account was gone. What hurt most wasn't the money. It was the realization that he'd betrayed his own rules. That's the hidden side of risk management. It's not about numbers on a spreadsheet. It's about emotional discipline in real time. Because when you're in a losing trade, your brain literally works against you. Behavioral finance studies show that losses hurt about twice as much as equivalent gains feel good. That's loss aversion. It drives traders to hold losers too long and cut winners too short. Here's the irony. Risk management is simple on paper. Define your stop, size your position, stick to your plan. But simplicity doesn't mean easy. Every trade tempts you to override it. Every losing streak whispers that this time is different. Every ego-driven urge says, "I can bend the rules just this once." That's why the pros treat risk rules like laws of physics, unbreakable, non-negotiable. Think about pilots. They don't wait until the plane is in turbulence to decide how much fuel they should have. The rule is fixed before takeoff. Same with surgeons. They don't improvise sterilization procedures based on how they feel that day. Rules protect them from their own humanity. Trading demands the same mindset. The traders I've seen succeed long-term have one thing in common: they respect risk before they enter. They accept losing is part of the game. They focus not on how much they can make, but how much they can afford to lose without emotional fallout. And because they play defense first, they're still standing when opportunity comes. Here's the trap: treating risk management as optional. It's not. It's the foundation that makes every other lesson possible. Without it, consistency collapses, psychology collapses, entire careers collapse. Which brings us to the next point, because once you accept that managing risk keeps you alive, the real challenge becomes managing yourself. Let's talk about the psychological traps that most traders don't even see until it's too late. Most traders expect the market to test their strategies. What they don't expect is how brutally it will test their identity. One of the most dangerous traps I've seen and fallen into myself is the ego and identity trap. When you tie your self-worth to your P&L, every trade feels like a verdict on who you are as a person. A win makes you feel brilliant, untouchable. A loss makes you feel like a failure. The danger here is obvious. You stop trading the market and you start trading your ego. Instead of asking, is this setup valid? You're asking, what will this trade say about me? And that's a deadly frame of mind. I once worked with a trader who had built a reputation in his friend group as the crypto guy. When Bitcoin dipped below 40K, he refused to sell. Not because the chart said hold, but because admitting he was wrong felt like admitting he wasn't who they thought he was. He held all the way down into the 20K before finally giving in. His loss wasn't just financial, it was an identity crisis. The second trap is lifestyle drift. This one creeps up quietly. You start with discipline. You wake up early, you journal trades, you manage risk like a pro. But over time, life gets in the way. A late night here, a missed journal entry there. You stop following your rules as tightly. Not because you made a conscious decision, but because discipline slowly leaks out of your daily routine. Before you realize it, your edge is gone. Not because the strategy failed, but because your lifestyle no longer supports it. I've seen this especially with traders who have early success. The money starts coming in, and they loosen the structure that made it possible. They skip preparation because they think they've got it. They chase entertainment or distractions instead of putting in the work. It's not a dramatic blow-up, it's a slow erosion. And the market punishes it eventually, every time. The third trap is recency bias. This one is wired deep into our psychology. When something happens, especially a big win or a painful loss, we anchor to it as if it predicts the future. After a streak of wins, traders increase their size recklessly, convinced the hot hand will continue. After a streak of losses, they shrink or abandon their system entirely, convinced the edge is gone. Both reactions are emotional, not statistical. Recency bias is why so many traders fail right before their strategy is about to pay off. They quit too soon, forgetting that the law of large numbers only shows its truth over dozens or hundreds of trades, not a handful. Ego. Lifestyle drift. Recency bias. 3 invisible forces that wreck traders quietly, from the inside out. The good news? Once you know these traps exist, you can guard against them. And the best defense isn't just awareness, it's structure. Which brings us to the next lesson, the tools and rules you can use to build guardrails around your psychology, so discipline becomes automatic instead of a daily battle. Let's pause here. Because everything I've shared so far, the traps, the rules, the lessons, they only matter if you turn the lens inward. So let me ask you, do you know your own psychological traps? Not the ones in the textbooks, but the ones that show up in your trading journal again and again? When was the last time you broke your own rule, and why? Was it fear, ego, impatience? If I took away your charts and only gave you your trade history, what story would it tell about your behavior? I've asked these same questions to traders I've coached, and the answers are rarely comfortable. But discomfort is where growth begins. Here's a simple exercise. Write down the last 3 trades that shook you emotionally. Don't just list the entries and exits. Write down how you felt before, during, and after. Then look for the thread. Was it overconfidence? Was it fear of missing out? Was it the need to prove yourself? That thread is the pattern you need to work on. Trading is a mirror. The market doesn't lie. It shows you exactly who you are under pressure. And if you're brave enough to look into that mirror without flinching, you'll uncover the real edge. Not a strategy, not a signal, but a mindset that can withstand the chaos. So ask yourself, what story is the market reflecting back at you right now? And with that, let's bring it all together. We've covered a lot today. From the hidden traps that quietly sabotage traders, to the rules that keep you steady, to the mindset shifts that transform chaos into clarity. But here's the truth. None of this matters if you keep it in your head. Knowledge doesn't change your trading. Action does. So here's what I want you to do. Take a moment and be honest with yourself. Which psychological trap shows up the most in your trading? Overconfidence? Recency bias? Revenge trading? Write it in the comments. Because the moment you name it, you start to take away its power. You turn it from a shadow into something you can work on. And don't stop there, share this video with a friend who might be struggling silently. You never know who needs to hear this right now. And if you found value here, hit like and subscribe so you don't miss the next deep dive. When you're ready to go further, click one of the videos above. I'll walk you deeper into trading psychology so you can keep building your edge. Remember, this isn't just about charts. It's about you. Master your mind. Master the market. Trade with confidence and live with calm.